Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing KIT's Eyecare stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. KIT's Eyecare is a vertically integrated digital eye care website. Its customers can buy contact lenses and eyeglasses, including the company's exclusive KIT's design products. Its digital platform removes intermediaries and enables the company to offer great prices and deliver made-to-order personalized products. This company is disrupting the industry by constantly pursuing cutting-edge technologies to enable the best customer experience, including online eyewear fitting tools, virtually trying on glasses, and an integrated online vision test. The website does 1,500 vision tests per month, with 44% of those customers buying glasses or contacts. The ability to do online vision tests is what makes this company different from others. This alone may catapult the company to massive growth. It costs this company $40 to acquire a new customer, and 62% of its customers buy from them again. Really impressive stats right there. 65% of its customers are female and 30% are ages 25 to 34. 1/4 of the company's contact lenses are auto-shipped to customers. That is guaranteed consistent revenue for the company. Getting as many customers onto the subscription plan is the best way to make a successful company. In the second quarter of 2020, it mailed out 5,000 glasses. And in the first quarter of this year, that jumped way up to 40,000. That's an 8x growth. They are growing exponentially. In addition to its own brand, it sells Acuvue, Tom Ford, Bausch & Lomb, Ray-Ban, Oakley, and many other eyewear brands. Its factory can make 2,000 glasses per day, with plans to expand to 4,000 per day. Its fulfillment center can send out 3,500 contact orders per day, with next-day delivery. Online optical sales in the entire market has tripled since 2009. Each day, more and more people are getting comfortable ordering their eye care products online. This company can leverage its virtual fitting tools and eye tests, given more people using the web instead of leaving their homes. Eyecare is a big market valued at $35 billion US. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2018. It started trading this year and can be found on the TSX and Pink Sheets. Let's get started with the model. This is a micro-cap company, 113 million market cap. They're trading at $3.64 a share, and they have 31 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have positive free cash flow in 2019 and 20, and they just started as a business in 2018, so that's saying a lot. But they did have negative free cash flow in the trailing 12 months. And we'll look at their financials later, but they've been investing a lot back into their company. Net income is the profit or loss on the income statement. It's revenue minus expenses, and they had a small positive in 2019, negative after that. Revenue is the sales for the company, and that doubled from 2019 to 2020, and then it grew about 10% to the trailing 12 months. This is the company's income statement. The top line is the revenue of the sales. Since we're looking at the ticker that trades on the TSX, all the numbers in this video are in Canadian dollars. Of their 75 million revenue in 2020, 61 million was from the United States, 14 million was from Canada. Hardly anything else from outside of those two countries. They could sell anywhere in the world since they're an online company. They don't have any brick or mortar stores. So that could be a future opportunity for the company to sell outside of those two countries. Below revenue is the cost of revenue. So the main cost of revenue is what they have to pay to the eyeglass companies to get their products to sell to their customers. Also, the expenses to make their own proprietary sunglasses. Of course, there's delivery expenses, then there's shrinkage, and many other expenses along the way. Revenue minus cost of revenue gives you your gross profit. So they're spending more money as a percent of revenue in the trailing 12 months when you compare it to 2020, since their gross profit is lower in the trailing 12 months, even with higher revenue. So this happens with young companies. They have to invest back into their business to grow it. So sometimes in the early years, you're a lot more inefficient because you're paying all these additional costs. Also, you don't have economies of scale. When they can start buying millions or tens of millions of glasses, they can buy it at a lower cost per unit. Below gross profit is operating expenses. So they had 21 million of operating expenses in 2020. 7.6 million was fulfillment. These expenses are from the warehouse when they receive, package, and ship items. Their highest expense was marketing, $7.8 million, then general and administrative expenses, this is payroll, then depreciation and amortization, $2 million. But you can see their operating expenses were really high in the trailing 12 months. It went up about 50%, but their revenue only grew about 10% from 2020 to the trailing 12 months. So this $33 million operating expense number is for the last 12 months. I couldn't get the breakdown for the last 12 months, but I did get the breakdown for the first 6 months of 2021. And you could see in marketing, they spent $8.8 million in the first 6 months of the year. In all of 2020, they spent $7.8 million. So you can see their marketing has gone up a ton. Same thing with general and administrative expenses. It was $5.2 million in the first 6 months of the year, and all of 2020 it was $3.8 million. So really there's nothing you can do about the numbers. You can't change it. You can just look at it, understand it, and try to make a decision if you want to invest in a company. But it does seem reasonable that their marketing would go up because they're trying to reach more customers. So you have to trust the management that they're doing the right things with their money to try to grow the company in the long term. So they do have negative operating income in the trailing 12 months. They did have positive in 2019 and 20. So if they wanted to, they could have had positive operating income. They could have slashed marketing and they could have stopped investing in other things. But that's only a short-term solution. They're willing to accept negative operating income now for greater growth later. They do have a little bit of debt on their balance sheet. So they paid $3.8 million of interest on their debt. And they do have negative net income in 2020 and the trailing 12 months. They did receive a $4.9 million tax credit. So their net income is actually higher than their pre-tax income with that $5 million credit. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash because net income is your accounting profit or loss. It's not actual cash. So their operating cash flow is even more negative than their net income. Usually that's not the case because operating cash flow is net income and then you add back the non-cash items on the income statement. The main reason their operating cash flow is worse than their net income was they bought $9.6 million of inventory. So when you buy inventory, you have to place it on your balance sheet and that's a cash outflow because you had to pay for that inventory. But when you actually use the inventory, like when you mail out the sunglasses to the customers, then you put it onto your income statement and it's a cash inflow. So a company could load up on inventory in one calendar year and it looks like they lost a ton of cash. And then the next calendar year, they sell all that inventory. So it looks like they had a huge influx of cash. But it is possible the year they lost a lot of cash was better than the year they generated a lot of cash. That sounds confusing. But let me know in the comments if you want me to clarify that one. Also, they received that tax credit of $4 million. They have to minus that out on statement of cash flows because that was a non-cash item. Because the way GAAP calculates taxes and the way the IRS calculates taxes is different. So maybe in 2021, you reported on your income statement that you got a tax credit when you actually paid the IRS money. Or maybe another year, it looks like you paid $20 million in taxes on your income statement, but you actually paid the IRS $10 million. It does even out over time, but the company keeps track of how much they over and underpaid the IRS on their balance sheet. They did spend a lot on CapEx in the trailing 12 months, $3.2 million. I know they're trying to build out their factory and fulfillment center. So they had a big negative free cash flow in the trailing 12 months, positive in 2019 and 20. They added $23 million of debt in 2019. They've been paying down that debt each year after that. And they also added $7 million of capital stock. They have $58 million of equity on their balance sheet. They raised $75 million from issuing stock, and they lost $15 million from running their business. Let's look at the capital structure. $58 million of equity, $19 million of debt. They're 76% equity, 24% debt. And it looks like they could pay off all the debt with the cash on their balance sheet and still have $5 million of cash left over. Their weighted average cost of capital is 8.13%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $231 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $162 million. We divide that by 31 million shares. And we get a calculated stock price of $521. They're trading at $364, so they're trading at a 30% discount. It's a buy according to the model. So the average analyst forecasted their revenue to grow 24%. So I grew their revenue 24% from 2020 to 2021, all the way to 2024. It looks like they are investing a lot back into their business, so I kept them at negative free cash flow in 2021, 22, and 23. The average company converts 10% of their revenue to free cash flow. So in 2024, I have them at 13 million free cash flow, which is 10% of 127 million. So of course, this company can go in many directions. It could be a huge success or it could be a failure. So far, it looks like they're doing a good job and they have really good technology. I could only find one company that valued this stock. It was Canaccord-Genuity. This is an investment bank in Canada. And in February, they were trading at $8.20, and this company's valuation was $17. So they're saying the stock is really, really undervalued because it's so much lower now. The stock has pretty much only gone down since it IPO'd. So it's really struggled. I'm not exactly sure why. But that's a problem with these really small stocks. They're just not well known, so not a lot of people buy them. So even if they have really good fundamentals, you may sit there forever and the stock won't go up. And you can invest in a company with terrible fundamentals and everybody's buying it for some reason and it's going way up. Warby Parker is a similar company, but they're a private company, so we can't see their financials. They did report they had $250 million of revenue in 2019. And they mainly sell online, but they do have some brick and mortar locations. What this company does, you can choose 5 frames from their website and they'll mail you those frames for free. You could try them on at home and then mail them back and buy whatever you want. And this company has programs where customers upload a photo and try on frames virtually through their mobile app. But KIT's technology is head and shoulders above this company. COVID should really help this company because ever since COVID, less people are shopping in brick and mortar locations and they're doing a lot of their shopping online. This is from KIT's report. They mentioned they received new customers from the COVID pandemic. And the stock has done really poorly, down 60% since it IPO'd, while the S&P is up 28%. The 52-week low was $3, the high was $10, and the stock is trading well below its 50-day and 200-day moving average. Not many people buy this stock. Only 50,000 shares are traded each day. Of the 31 million shares outstanding, 4 million are on float, so it's a really low float. Only 1.24% are held by institutions, and pretty much none of the shares are shorted. Analysts are really bullish on this stock, projecting their earnings to grow 45%, their revenue to grow 24%. Those are really big numbers. In the past 90 days, the stock is down 50%. In the past 30 days, it's down 28%. Its industry is down as well, just not as much. But the market overall is up. If you invested $10,000 when this company IPO'd, you'd be down to $4,400 today. That's a 56% loss. LD Group is the biggest shareholder at 34%. Then the founder and CEO and other people connected to the company own a lot of stock as well. Let's look at their financial ratios. We can't look at the PE because they have negative net income. They have a really good price to sales ratio. Their market cap has come down so much since the IPO, and their revenue is up. So just based off of the price to sales ratio, it seems like the stock is at a really great value. And they also have a really good price to book at 2.0. They do have a lot of intangible assets on their balance sheet, 41 million. They have a high current ratio and quick ratio. They have 24 million of cash on their balance sheet, 15 million of inventory, so they are sitting on a lot of inventory. And they did have 21 million of negative free cash flow in the trailing 12 months. If they do that again the next 12 months, then they're going to only have 5 million of funding since they have 26 million of working capital. That means they're going to probably need more debt or equity financing to run their business. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 13 other companies in the same industry as KIT's. And if KIT's has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have a really good price of sales, price to book, and current ratio. They have negative net income, so they have a bad PE and ROE. They are lower in debt than the average. And they're by far the smallest company on this list, only 113 million market cap. Most of these companies make that much money in a day. So to summarize, I have them trading at a 30% discount. The difficult thing is with a company so small and not well known, not a lot of people buy the stock. Even if they have good numbers, they would need to have amazing numbers and have billions of revenue for people to be aware of them. But at these small numbers, they just fly well below the radar. And if people like me or you buy the stock, it doesn't change much. They need like a Fidelity or BlackRock to buy millions of shares. That moves the stock price. And those companies usually don't buy stocks under $5 or under a certain market cap. So I'm surprised this trades on the TSX and not the TSX Venture or the CSE. Because this stock cannot meet the standards to trade on the NASDAQ or New York Stock Exchange. It can only trade on the pink sheets. But this could be a diamond in the rough, and you may make tons of money. Only time will tell. I ranked their free cash flow as 1 out of 10, their revenue 4 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.